Recently, SEBI has warned investors regarding the froth in mid-cap and small-cap sector. In fact, SEBI has issued a circular to MFI to put brakes on the rapidly growing small-cap and mid-cap equity category. And then RBI stepped in and banned IIFL Finance gold loan business. Then it banned JM Financials from doing any form of financing against shares and debenture, including disbursals of loan against IPO of shares. So it looks like both SEBI and RBI have joined hands to reduce the excessive liquidity from the market, especially from mid-cap and small-cap segment. And it is also visible from the returns. In last 1 month, Nifty small cap is down by 3.5%, mid-cap has been flat, and large caps on the contrary are up by 3.5%. The question here is, why RBI and SEBI wants to reduce the liquidity in mid-cap and small-cap? Is the Indian market really in a frothy stage, especially the mid-cap and small-cap sector? And can there be a significant correction in mid-cap and small-cap stocks in coming months? Hey everyone, my name is Sahil and this is my Personal Finance Academy. FY24 has been an exceptional year for mid-cap and small-cap sector in India. Small-cap index has generated 65% return so far in FY24, and that is after slowdown in last 1 month. Otherwise, the returns were around 70%. Mid-cap index has also generated around 65% return, whereas Nifty 50 has generated around 30% return so far. Clearly, mid-cap and small-cap have outperformed the large-cap index big time. As a result, there's a huge amount of investment in mid-cap and small-cap index. And even individual investors only want to invest in mid-cap and small-cap companies. And that has made both SEBI and RBI a bit worried, because such returns are not normal. At the end of the day, stock market is linked to the economy. And when the economy is growing at say 6 to 7%, and if you add inflation of 5%, the average return expectation is 11 to 13%. But FY24 returns are multifold times higher. So in this video, I want to help you understand first why RBI and SEBI are worried and want to reduce liquidity from mid-cap and small-cap equity segment. Second, what does data actually suggest about froth in mid-cap and small-cap space? And third, is it time to sell mid-cap and small-cap stocks? Alright, let's deep dive. Over the last few days, SEBI warned the mutual fund industry, showing concern over the mid-cap and small-cap segment, and RBI action on IIFL Finance and JM Financial has certainly created a negative sentiment around mid-cap and small-cap stocks. But the question is, why SEBI and RBI are worried about rise in mid-cap and small-cap sector? Isn't it a good thing? Well, everything looks great in the stock market when the market is going up. But what happens when it goes down? Because after a point, when the valuations become too expensive, it creates a bubble. And we have seen it in the past, what happens when the bubble bursts. You don't need to go years back in history. Just look at 2016 to 18 period. So 2016 and 17 were again exceptional year for mid-cap and small-cap sector. Small-cap index jumped more than 100% and mid-cap index jumped around 70%. However, over the next 18 months, small-cap index tanked around 35% and mid-cap tanked 25%. It was a brutal correction. In fact, many individual stocks tanked 70-80%. I'm sure majority of young investors who have joined the market post-COVID have not experienced this yet. Please note that I'm not trying to scare you. All I'm trying to say is the market should have some sanity. Also during 2018, the economic condition was not great. There were challenges due to IL&FS crisis, Yes Bank, NPAs were at all-time high, then demonetization resulted in huge liquidity crunch. And today our economy is looking in a very good shape. So you can't strictly compare 2024 with 18, but the problem is that due to crazy return in small cap and mid cap post-COVID, young folks are expecting 10-20% return every month, and they expect stock to double every 6 to 12 months. It's because they've seen only one-way rally, especially in last 10 months. Now if you look at equity mutual fund industry, the overall AUM of small cap fund is now at 2.48 lakh crore in January compared with 1.31 lakh crore in the same period last year. That's up by 89%. While mid-cap funds are at 2.9 lakh crore versus 1.83 lakh crore in the same period. That's around 58% jump. People are pumping money big time in mid-cap and small cap. So what happens is, when there's a big froth in the market and when the markets start cracking, people start redeeming money from equity mutual fund. And that puts a lot of pressure on mutual funds. They have to sell stocks to honor the redemption, and that further creates selling pressure and a vicious cycle, which is not good for investors. Also these days there's a huge craze in the IPO market as well, especially if you look at SME IPO. Many stocks are getting 100 to 200 times subscription, and many stocks are doubling on listing day itself. That has made IPO a pure gamble. People are borrowing money to invest in IPOs. In fact, People also borrow money to buy stocks. So everything looks great during bull run, but eventually it creates froth and correction becomes inevitable. So what RBI and SEBI are doing is a brilliant step to avoid that havoc in the market. I think it's very important to have some sanity in the market. Now let us look at the data points to understand, is there really a fraud in the market and should you sell mid-cap and small-cap stocks? See, first of all, it's important to understand, is there a fraud in mid-cap and small-cap index? Because in that case, big money might not flow into it. And when I say big money, I mean DIs and FIs. So DIs are driven by retail investors, money, and SEBI has already warned DIs to put a brake on mid-cap and small-cap equity AUM. And some of the DIs like Kotak, Nippon, Tata have already imposed restriction on lump sum investment in small-cap mutual funds. Although the SIPs are still going on. Then there's a very popular category of flexi-cap fund where top flexi-cap funds are already skewed towards large-cap side and incremental money is being invested in large-cap segment. Second, FIs are already very cautious of the Indian market at the moment, mainly because of general election coming in. But the key parameter both DIs and FIs would check before investing in small-cap and mid-cap stock is valuation and growth. You can't just look at valuation in isolation, because if a company or a sector or in general an index is growing at a healthy rate, it can command a premium valuation. Vice versa, if the company or sector or index growth is slow and valuation are higher side, that can result in correction. So if you look at valuation of all three index, Nifty 50 PE is 23.9, mid-cap PE is 27.2 and small-cap PE is 28.5. Now historically, the median PE of Nifty 100 is at 2021. So you can say that Nifty 50 or Nifty 100 is actually trading at around 10% premium. Then mid-cap 150 and small-cap 250 5-year median is around 24-25. So mid-cap index is trading at around 10% premium and small-cap index is trading at around 15 to 20% premium. So overall, I don't see the market very frothy in terms of valuation. If you look at revenue growth, in last 1 year, Nifty 100 earnings have grown at 19%, mid-cap earnings have grown at 38%, but small-cap earnings have grown only at 3%. So the concern here is not just about valuation, but valuation as compared to earning growth. At the moment, Nifty small-cap earning growth is quite low, at least for the last 1 year. So going forward, the earnings have to catch up with valuation to avoid the fraud. Or some 10-15% correction would make the valuation fair. So that's the fundamental level analysis. The key takeaway is that valuation don't look too frothy at the moment. So no need to panic or take extreme measures. But the market in the short term is mainly driven by sentiments, and there are many factors that drive those sentiments. First of all, we have already discussed SEBI and RBI stance on mid-cap and small-cap. So that has created some negative sentiment, at least for the short term. And then we are in a March month, which is always sloppy due to year-end activities where investors book profit and also do tax harvesting. So March month can see some further correction here and there, especially in mid and small cap. Now if you look at market for the next few months, two key factors would drive the market are interest rates in the US and general election in India. Interest rate in the US have not yet started to reduce, so that would be a key factor. If the interest rate starts falling, we'll see good liquidity. And of course, a lot would depend upon the election outcome as well. If the incumbent government wins with a majority, market would cheer it. However, the problem is that market has already discounted the BJP victory in the near term. So any failure to live up to the market expectation can result in correction. And if the election results are as per market expectation, it will rise. So that's the short-term guidance. In any case, the next few months looks volatile, especially for mid and small cap. Having said this, if there is correction or consolidation in mid-cap and small-cap stocks in the next few months, it will create excellent buying opportunity in a systematic manner. You don't have to rush to buy the stocks, but keep a list of good mid-cap and small-cap stocks handy in case of correction and grab the opportunity. Again, this is strictly for long-term investors. I don't discuss short-term trading. At the same time, I think it's important to make a fine balance across large, mid and small cap. I always say that. And you can also follow a good fund houses to understand what they are actually doing. For example, I was going through the latest holding of Parag Parikh FlexiCap Fund and they have increased stake in HDFC Bank. I have already mentioned that at current levels, the risk rewards are extremely favorable for HDFC Bank. Then they have increased stake in Kotak Bank, ICICI Bank. So they are clearly bullish on the banking sector. Again, they don't have just a few months of expectation. They invest for a long term. And personally, I also feel that banking sector is much better placed in valuation as compared to the other sectors. Then they have increased stake in Bajaj Holding, Power Grid, ITC, etc. So that is also a good way to look at it. It also says that you will always find opportunity in the market at individual stock level. At last, all I would say is, if you're a long-term investor and have a fine balance across large, mid and small cap segment and good diversification across important themes with investment in fundamentally strong companies, there's no need to panic. By the way, I've recently done a video on 9 key themes and top stocks in each theme. You must watch it. As far as long-term picture is concerned, Indian economy is in a very sweet spot. I keep saying that we are the youngest nation in the world, growing at one of the fastest rate, and there's a new equity investment culture started in our country. These are structural changes. Plus, FIs can't ignore India. So the long-term picture is very, very bright. Try to avoid getting distracted with too much noise. Just stick with your fundamentals. I'm sure if you do that, you all would create wealth. And personally, I anyway share my own investment strategy in my weekly video series where I have recently shared my portfolio and key themes and stocks I am bullish on. Again, it's not a buy or sell call. It's only for education purpose. The idea is to share my conviction with you all along with the knowledge. So this is it for this video. I hope you'll find this video useful. If yes, do share it with your friends. Also let me know what you think about the current state of market and what are you doing. Are you holding, booking profit or using correction to invest systematically in fundamentally strong companies? I'll see you next video. Till then, take care.